Hello, I'm Mortgage Mike, and welcome to another weekly installment of your mortgage industry update. Today's topic is on the continuing tightening in the credit markets, and more specifically, Fannie Mae and Freddie Mac, and what do we do with them from here. As you may well know, Fannie Mae and Freddie Mac have been under government conservatorship for the past couple of years. Now, Fannie Mae was started back in 1937, and Freddie Mac came around in 1970. They're chartered by the government. They have always been quasi-governmental entities. So that means that there's always been this implied government backing, but they came around to help fund the mortgage market. So when we begin to think of demand for money in the housing arena, we have two markets that we work in. We have the primary mortgage market, which is the market where we buy and sell homes. You have a lender in the middle of that transaction, which would be me or any of the other lenders out there. And then finally, you have the secondary market, or the supplier of funds for home financing, and those suppliers are Fannie Mae, Freddie Mac, FHA, and VA. Well, Fannie Mae and Freddie Mac did a great job up until about probably 2002 when they began to loosen their credit guidelines. They started to dabble into the many crazy instruments that Wall Street was putting together out there, and consequently we saw a collapse in the housing industry, and Fannie Mae and Freddie Mac came under conservatorship of the United States government, and consequently we've had a taxpayer bailout. Now, what do we do with these entities now that we have to transition them out of government ownership and back into some private hands or something? Well, the Obama administration has come out with a white paper, and there's three options that they have presented to us. And that first option would be to just basically take the government completely out of the equation and let the private markets run the mortgage markets once again. I'm not sure if I like that too much. The big banks seem to like that, although I think that's another recipe for disaster, as they run unchecked in a marketplace and eventually, the taxpayer bails them out. Option two would be to have Fannie and Freddie come in and play a very limited role in the marketplace, where they would provide funds to rural housing, very low income people, and then potentially in some veteran programs, and then potentially being a backstop in case we need to provide more liquidity if there's a crisis out there, another housing related crisis. And the third option, which seems to be the one that most people can agree upon at this moment, would be to put together an FDIC type program. It'd also be a program that more closely mirrors what the mortgage market looks like today. Basically, we would turn the government sponsored enterprises, Fannie and Freddie, back over into private hands, and then would have a government insurance program that would be there to provide the safety net if everything fell apart. So what does this mean for us, though? Well, it doesn't mean that lending's going to get any easier. It means it's only going to get harder over the course of the next several years. The administration's goal is to release Fannie and Freddie over the next 5 to 7 years, or release their ownership in it in the next 5 to 7 years, and that means that there's going to be tightening in the credit markets once again. We could potentially see increases in down payment requirements in Fannie and Freddie. We're already seeing the fact that the add-ons to pricing for less than 740 FICO scores, less than 20% down payments, are already coming into play, and those add-ons are added to the interest rate, which increases the cost of financing. Also, we're going to see the G fees increase from Fannie and Freddie, and G fees are the fees that Fannie and Freddie charge on a monthly basis to provide funds for housing for each loan that is made. Consequently, when that fee goes up, well, that fee is passed on to consumers, so we'll see an increase in fees there. FHA, we're going to see some increases in their marketplace too, because we're already seeing that the new requirements from FHA monthly premium, which was at 0.9, is now going up another quarter of a point to 1.15. So as we look around us in this ever-changing mortgage landscape, what we're going to begin to see over the course of the next several years is that lending, unfortunately, is going to get harder, it's going to get tighter, and the cost of financing ultimately is going to go up. So if you got clients out there that are looking to buy a home, or if you're looking to buy a home yourself right now or refinance, boy, now's the time to do it. The longer you wait, the more the opportunities that you're going to find out there are going to diminish, and you may find yourself sitting on the sidelines without a home, or you're going to be paying a lot more money for it. So this is Mortgage Mike saying thanks for listening, and I'll see you next week.